think of all the people that had a fortune in the tech bubble that lost it all because they didn't know how to protect themselves.
Exactly.
And so it's more about preparedness. I don't think if you went back and asked him, I think you would be honest and say, I didn't know that Yahoo was going to collapse. And I didn't know,
from $100 to
right.
$5.
And he didn't know the timing of that, but he said, well, what's my risk and what's my reward? If the stock keeps going up, I'm going to make a fortune.
Welcome to the Cashflow Academy podcast. This is where we do our best to make investing simple. And we have a great topic today. We're going to make it simple. Short in the market, the big short, Burry. We're going to talk about all this stuff. Joined by Noah Davidson. How are you, sir?
I'm short.
You're short the market?
Short the market or short in stature?
You can't joke around with that.
You heard me.
And we have Corey Halliday. Thanks for coming.
I also am short, but if you add Noah and I together, we equal one Andy. So we stack on top of each other's shoulders.
How do two shorts make a long?
We just need to get a trench coat and some sunglasses. And
oh my gosh, man.
Be Andy for Halloween.
How do two shorts make a long? I don't know. Hey, interesting stuff. So have you guys seen the movie The Big Short? Did you ever see it?
Yep.
Did you see it?
Awesome movie.
I thought it was, certainly not for the kiddies.
Yeah.
Certainly not for the kids. But I thought it was kind of funny that in order to, follow the plot, they had to define things like CDOs, and they'd have who is in it? Who is in the bathtub teaching what a CDO was?
I don't remember who, but I do remember the scene.
Yeah.
I don't remember who it was.
And for those that don't know, CDO and CDS, they're credit default obligations or credit default swaps. And
collateralized debt obligation.
Yeah.
Corey's not in the tub. No one's going to listen to that. So I don't know that we can quite match the dramatic attention getting. But I thought it was interesting. And every once in a while on that show, they would have to stop and they'd look at the camera and they'd stop the acting stuff and let me tell you what this means. And so it was an interesting show, and it was funny. I went and saw it with Patrick Donahoe. Do you guys know Patrick?
I don't.
So Patrick owns Paradigm Life and founded that company, and we went on what's called a mandate. There's different types of mandates. There's healthcare mandates and other mandates, but we went out on our own mandate, and we're sitting there watching it because we didn't think our wives would want to go.
Yeah.
So. Anyway, so the Christian Bale's character,
Michael Burry.
I think I mentioned a couple weeks ago, I set up my drums again. It was pounding my drums, and I thought of myself of Michael, or to me it's Christian Bale almost. But he, I don't know if he was lucky or smart. I mean, it's kind of like Mark Cuban. Smart. This is what's tough, and probably more important in this discussion that we'll evolve into. It's not so much about, whether we should short or not, or it's going to be about how do you respond as an investor if Buffett does this, or Cuban does that, or Burry does this, or Soros does that.
Or the government or the Fed.
Yeah. Like, how do you react if someone who you feel is smarter than you, and for me, that's a very large section of the population, right? If someone that is richer than you says, do this, do you do it? So we'll get into that. We'll get into that for sure. But the news is apparently that, let's go back. Let's go back to Cuban. Let's not get too far ahead of ourselves. So Cuban starts a company called broadcast.com. Well, he starts out tending bar and gets some skills there apparently. And then he sells his broadcast.com. They're broadcasting, baseball games around the world.
He's a Hoosier basketball fan. He was trying to stream his basketball games.
All that stuff. And he sells it for, I want to say $5 billion or something in stock.
5 or 6 billion, I think, to Yahoo, right?
Yeah, and he didn't do it. And okay, so here's the thing. Part of that was probably Yahoo. It was much easier to give him stock than raise cash. I get that on Yahoo's part of the deal. But if you're Cuban, if you thought the stock was going down, would you have wanted stock or cash? If you really thought the stock was going to tank, wouldn't you have wanted you want to own and have a position in something that you're thinking is going down? So he's on 60 Minutes with Mike Wallace or somebody, I can't remember who it was, a long time ago. And he says, yeah, I had insurance. I was covered, basically. I'd hedged this. And he'd bought some puts on Yahoo as protection.
Yep.
So I'd love to ask Mark, because, it looks like he's a genius. Oh, I knew Yahoo's going to tank. Well, then why'd you take stock? He said I was covered. In other words, if my house burned down and I said, yeah, I was insured, are you saying, Andy, how'd you know? How'd you know to buy insurance? Or was it I just understood there was a risk? I have a large amount of money in a house. I don't want to, there's a risk there. Well, maybe he said, look, I think Yahoo, he's the biggest tech fan in the freaking universe, right?
Yeah.
And so maybe he bought some puts prudently, but not opportunistically. He did say he was covered and then some, so maybe it was opportunistic. So when I look at that, I say, okay, is Mark a genius? Clearly, anyone that can make a deal like that gets a genius label just to get to that point, obviously. But was it truly prognostication or was it prudence? And saying, look, it's probably wise for me to have this. And did he really think it was going to crash that far, and that those puts would explode that far? I'd like to ask him. I think he'd be honest if someone had asked him. I don't think I don't think his hubris would get in the way of that.
Yeah, and I think it's a little bit of both. He was lucky and he was smart, right?
Yeah.
So the timing of everything really worked out in his favor. But he was very intelligent in being able to utilize financial products and things to his advantage. And
he's a trader. He knows some things. I used to follow him on Twitter back in the day when it was cool.
He knew what a put was.
No, but he knows quite a bit about actual trading. Like he's a pretty smart cookie. So yeah.
A lot of guys don't even know what that is. I know a lot of business owners that have no idea what that is. Right. So
and there's
Cuban's
a lot of
smart
people.
Dude.
There's a lot of people that got deals similar to Mark Cuban's, whether it was that much money or not. Think of all the people that had a fortune in the tech bubble that lost it all because they didn't know how to protect themselves.
Exactly.
And so it's more about preparedness. I don't think if you went back and asked him, I think he would be honest and say, I didn't know that Yahoo was going to collapse.
And
I didn't know,
from $100 to
right.
$5.
And he didn't know the timing of that, but he said, well, what's my risk and what's my reward? If the stock keeps going up, I'm going to make a fortune. But if it goes down, I don't want to lose all that money.
Now, as a Series 4 option principle, to you, this just makes total sense. I've heard you say it. I think you and I would agree. I'm not going to trade stocks without an options market.
Yeah.
I'm not going to do it.
Sure.
Right? I'm not going to do it without. I got to have a way to protect. So fast forward to The Big Short. These guys basically invented a derivative, Burry, and he invents a derivative that basically says, I want to buy insurance on these CDOs.
Yeah.
And when those collapsed, his insurance contracts were worth insane amounts of money.
Yeah.
But here's the thing. He did his research at the clubs.
Yeah.
Saw the dancers buying
6 and 7 properties.
They were all real estate investors. All of a sudden, he's like, okay, this is a train wreck. And he really looked at the nice thing about loans is they have a term.
Yeah.
Right. And he says, look, here's where it's going to happen. Here's the day. And it didn't. And it didn't. And it didn't. And he's freaking out. It's like, why didn't this, in the movie anyway, why isn't this happening? Well, how many guys, we don't know who had done it before and missed the boat and who had set it up after that was too late, and he happened to be the guy. And he looks like a genius in hindsight because it's the same as Mark Cuban. Oh, how did you know? Andy, how did you know your house was going to burn down? You genius. You bought insurance. Well, you're a genius. Or did he just happen to be the guy that hit it right?
And you look at that story, so as it's portrayed, and I assume this is accurate, that the investors were trying to force him out of the positions, that they were losing money. So these CDOs and CDSs, they're basically collateralized debt obligations, or
they're
CDS credit default swaps. They're bundles of assets that are default risk. So a default is when, let's say it's a loan, well, you can't pay your loan. Well, you default on that loan, and now that asset becomes the property of the banks. And a lot of these loans were packaged together. So they were terrible loans singularly, but then they put them all together and they said, well, now they're AAA rated because they're all together as a package. And not all of them are going to default, right? Some of them might, but if we package them all together, even if a few do, they'll still be okay. And so they gave them a great rating, which was
S&P and Moody's,
really what he spotted.
S&P and Moody's probably should have rethought that, because what they thought was, well, it's real estate. People are going to pay their mortgage. It's real estate.
Yeah.
And so by bundling them, they kind of said,
it's terrible.
This is housing stuff. This is good so to give them a AAA rating was rough. And he says these are not AAA. Bought the set up the insurance against the fall, and just boom.
But as it's portrayed, he was originally losing a lot, right? Because it wasn't happening in the time frame that he expected.
Yeah, he was freaking out.
And so the investors were trying to force him out of the positions. Now, if you're forced out of the position, you're taking a huge loss because you're selling at the current price, which obviously was not good for him. Now, he had legal ability to stay in those positions, which absolutely saved him. Otherwise, he would have, he would have been forced out of those positions.
And I might not understand this correctly either, but, insurance is based on premiums. And if you don't pay your premium, your insurance will lapse, and those contracts are now void. So it's my feeling that he had some obligations to maintain that position that required cash.
Yeah.
And that really put the strain on it, because you're still investing in the insurance, and they're saying, hey, we don't need this insurance. And insurance is a speculation. It's a tough business. To me, insurance is a liability that becomes a possible asset someday. But it's just like the gold we talked about, in another episode. When I buy physical gold, and I don't ever see myself getting that money back or a gain on it ever. Hopefully I die, and hopefully my kids die, and my great-grandkids die, and that just stays in a family trust or something. But so now fast forward today. So here's your thing. You've got this Michael Burry who, makes this incredible, trade, one of the, maybe a top 5 nominee, right? If there was an Academy Award show for great trades, you got Soros taking over,
taking down the Bank of England.
You got Buffett, probably the warrants on U.S. Bank during the subprime.
How about his Apple position?
His Apple was really nice. So there's been these great trades, and Burry and The Big Short. That's amazing. So now someone reads this and they say, oh, he's gotten rid of all his banks now, all of them. And I guess I didn't follow what he did when Silicon Valley Bank got killed. I bought some banks because the general fear of it.
Well, the sector got crushed.
The sector got crushed, and so I went and we had a conversation about book value, and there were opportunities that were less than $1 book value. In other words, you could buy $1 for 60 cents. In book value, and maybe the ratings and the stress tests and all that will prove that I'm an idiot. But I have one that I bought some USB, and Buffett left USB. I bought USB, but here's the thing: my price on USB after he left it was a lot lower than his price on USB when he bought it. And do we have to have a banking system? Is that a necessity like food, clothing, shelter? So anyway, I bought some banks, and I'm getting called out of one of them because its price has gone up. And it's gone up too fast that I'm going to get called out. Okay, that's fine. I still have some others, and I don't know that I'm that excited about adjusting that trade. Dividend is okay, but I'll call that more of a trade than an investment. Got called out.
Or sell some puts and get back in
if
it comes back down.
Yeah, maybe. At the same. I might sell some puts at the same price I got called out at. I'm only in the money, $1 or so. So it wasn't like it blew through it. But here's the thing. Now he's sold all his banks, and he takes.
This is Michael Burry.
Yeah, he sells all his banks, and he takes like an $800 to $900 million position in long puts on the SPY, which is a lot.
Yeah, almost $1 billion.
Flirting with $1 billion, like 890 something, I think it is. And then you've got he's got a 720 or somewhere $1 million short or bearish position. It's not. He's long puts on the Qs, on the NASDAQ. So a person, watches it and they read about it in Yahoo Finance, and the trap I think is they say, well, he's smarter than me and he was right before. So, and the rumor is, I've read this in some articles. I don't know if it's true, but the rumor is those two short positions make up 93% of his fund.
That's a big bet.
It's a huge bet,
dude. It's an all-in.
It's
bet.
Actually an irrational bet. If it's 90,
it's all in. He's all in.
And I think
right?
that's the magic word. The market can stay irrational longer than the puts contracts last, or the market can stay rational, irrational longer than the.
So I've always considered myself a student. I've done okay, but I'm not in his league, right? I mean, I'm not managing a multi-billion-dollar fund, right? And so a guy like me might look at this and say, well, gee, he must know something I don't. He must be smart. And I will just give an opinion. I could be wrong. I've fallen into that trap in my life more than once, where someone who I respected or looked at as being more successful than me, I doubted my own common sense. I doubted my own intuitions simply because, and I think you have to weigh it. If Buffett makes a move, you got to weigh it.
Well, Buffett's been a net seller of stocks, according to the last report, right?
So, I think sold all of his banks except for Bank of America.
He's not going to sell Bank of America because how he picked that up was his price on it is awesome. So he's not going to sell that.
But it is interesting when they're selling these assets and you own some of them. It does make you, to your point, it makes you think. It makes you stop and think. Well, what do they know that I don't know? What do they see? But I can tell you, since the financial crisis, how many people have come out and said the market is going to crash, it's going to collapse, and try to predict that. And these are people that are very intelligent, and yet it's truly somewhat unpredictable to predict a crash, because that's the very nature of a black swan event, is its unpredictability, right?
Right.
If it was easily to predict,
there's many a broke bear out there that has attempted to predict the top. And it was like we had the conversation about the balloon expanding and which one of the possible catalysts is going to be the thing that, the everything bubble pop.
It's weird because fundamentally I'm as big a bear as anybody probably is. And yet my delta is
bullish.
Bullish.
I mean, my delta is still significantly.
This goes back from my trader days. Like, you trade what you see on the chart, not what you believe in your head, because the market doesn't really care if you're right or if you're rational. It's going to do what it's going to do.
So in the last podcast, you talked about, and I did not know this, that Newton got taken out in Tulip Mania.
Yes. Sir
That's
Isaac
Newton. This dude invented calculus.
Lost his ass.
Didn't he invent him and one other guy? It was really weird because you have all this time on Earth, and Newton and one other guy that didn't know each other both invented calculus at the same time. That's weird. Yeah. And it wouldn't be that, how do we come to that point where we have to solve algebra? So you got the dude that invented calculus. See, I thought Satan invented it when I was taking it in school. I was pretty sure that it was the devil's work.
Well, he was the other one besides
to inflict pain and torment man.
He was on the other side.
Yeah. So he gets caught up. Tell us that.
Tulip Mania. I mean, for those who don't know, Tulip Mania was this idea that these tulips. I mean, tulips, right? The bulbs.
Yeah.
It became a hot commodity, and it just became. It was a contagion. People got excited. They'd run out and buy it, and he got in early on that and made a bunch of money and got out. But they kept going up, and they were getting up to the point where one little bulb was like an annual wage for people. And the greed gland kicked in, and he bought a bunch more, and then it collapsed, and he lost all that. So,
and it's interesting when you're in a position where you're making some money, and then it goes back to your break even. There's a psychological thing that triggers where it says, "Oh, I should have sold up there. Well, now I can't sell and then it goes into a loss, and now you for sure can't sell."
It's your classic sunk cost fallacy.
Exactly.
Right? So.
And I think the U.S., it's kind of interesting, not to transition, but the U.S. is in that in the Strategic Petroleum Reserve in oil.
Yeah.
They had a great trade. And so here in the U.S., the SPR, I've read about that, and it's kind of interesting. They have salt caverns in Texas and Louisiana and some of these places where they store oil and so on, because oil will spoil, right?
Yeah.
It has to be used and consumed.
You're a poet and didn't know it.
Yeah, exactly.
Oil will spoil.
And we saw that in 2020 and COVID, where oil
Negative.
it went negative in price because nobody was using it. There was way too much supply and it was spoiling. And what some people will do is they'll actually store the oil in different places if there's an advantage, what they call contango in the futures, where they can lock in contracts that say, well, I can buy it at 75 a barrel in August, and then I can lock in my sell price in December at 85 a barrel. Okay, if there's that pricing differential, I can take advantage of that and store the oil. Well, the U.S. stores oil. That's its SPR. When Russia invaded Ukraine and oil prices went up a lot, the U.S. released some of the SPR and has taken it down to a significantly lower level. They've sold a lot of the supply. The idea would be that they would buy it back. Well, prices did collapse down and they never bought. And it was interesting. And now prices have come back up, and they've been on record as saying, well, we will do it when it's back to the taxpayer's advantage, which is essentially telling the market, well, we'll do it if it will go back there, which means now you're telling the market where you want to buy. It's very unlikely that it goes there. Or if it does, if there's enough supply that drives it all the way there, it's probably going a lot lower than that. So they're kind of stuck in that. And that's probably what Newton got stuck in was, as the price comes down, well, I can't sell it now because I should have sold it there. And then it gets worse and worse and worse. And this is temperament. You have to have a good temperament. You can't get stuck in that fear and greed and all these emotions driving your decisions.
Well, I've loved studying the chart patterns of market crashes and corrections because they're so similar. Like it kind of goes through this early stage of denial where, it takes a hit and then the market rallies up and then people doesn't make those new highs again, then it starts to go. And then once it hits that point of capitulation, it like the fear just grips the market and it panics. And it's like everybody's heading for the exits at the same time. And I don't know, it reminds me of that scene from Trading Places where they're doing the orange, the futures contracts and just buying them up from all the people who are panicking and selling. So it does create a bit of a panic. And then after that, you've got that thing on your wall in your office about, when people are fearful, that's time to be greedy. You don't have to necessarily predict the bottom, but you have to recognize when the panic's slowing down.
This is the big thing too, because the Burry play is a market timing play. And he had the advantage with the Big Short of loans have an expiration date on them. He had the expiration date and he was close enough in it that he timed it okay. I don't know where he's getting this now, where he gets the timing, and it's hard to do. So maybe there's the FOMO, right? I'm not really that afraid of the market to crash. I mean, my thought is, okay, if it happened overnight, there's nothing you could do about it. But historically, look at even the COVID crash, which was very severe.
Yeah.
You're going to break a 200-day. You're going to have an opportunity to defend, maybe with some future contracts, and you can beta weight. You get away from your bullish delta. You kind of beta weight and go neutral, but you're still not thinking opportunistically. You're thinking defense. But what I really like the idea is have some dry powder, and this is what I feel Buffett does. Yeah, he may have been net seller stocks, but the bigger issue is dry powder.
Yeah.
Because it's not, cash. I don't know that the opportunity is best for me at my education level to try to time that market where I put 93% of my stuff into something that's a time decaying element that if you're wrong, you're going to be toast. And if it boosts a little bit, the pressure on them to exit that is just brutal, right? I'd like to know what the term is on his puts. Are they leaps? Are they, what's the?
I think he for sure has quite a bit of time. I would imagine he
You would
bought.
think.
You mean he didn't just buy October options?
I would doubt it, but I mean, if you're putting that
October Bear.
It is true that the September-October time period is traditionally bad for the markets, but I highly doubt he bought 1 month options. Like, he's probably out there, in leaps 1-2 years out and trying to say, well, while I can't time it in the short term, I'm pretty darn he must be quite confident
Buffett
that something is happening.
Buffett has said, and he might have to use words because there are puts on these now. They're just not long enough. But Buffett has said if there were long-term puts on Bitcoin, he'd load it.
Yeah.
He said that. So he believes that there'll be a demise of that. I think it'll happen because of obsolescence risk. He thinks it'll happen for different reasons. But I think don't get caught up. I fell in that trap before. Well, here's a really smart guy doing this. I should do whatever he does. Look, if I can say, let's say the market does crash, I think I'd rather, because see, if I have dry powder stays dry. And when it crashes, go buy it up.
Yeah.
That's been the Buffett way to go. Rather than being opportunistic on the crash, we still love it. We love the crash. It's a sale. But we're not trying to make money on that movement. We're trying to make money on the bargain after it's gone. Because now I know it's down. I can see it. I know it's down.
And I remember having this discussion with you. We were looking at investing in a real estate syndication in Austin, Texas.
It was one of Than Merrill's.
Yeah, and you ended up investing in it, 100,000, 200,000. I don't remember what you put in.
There were two. There was one we did two in Texas in the same month. We did one in Fort Worth and one in Austin.
Austin was the one I was looking at with you.
Yeah.
And I want to say that the seller of that was Blackstone. I remember having this discussion with you because we were like, well, why is Blackstone selling? They're such smart real estate investors. Fast forward, you did a tremendous return on that.
Yeah, we almost doubled our money on that one.
Yeah, in a relatively short period of time.
It was like we got it. If you added up, I think over 2 years it was 86% return, I want to say, but that doesn't count the cash flow.
Yeah.
But
Blackstone was selling, and yet there's still opportunity. Warren Buffett sold banks, but you picked up some of the banks. He sold airlines, but you picked up some of the airlines. And I own some of those assets, and we bought KHC, but at a much better price than Warren Buffett. The point is that just because they're very intelligent doesn't mean that they always know. Nobody knows the timing of everything, and they're doing things that fit their portfolio. It's not necessarily that they hate that asset. They're saying
rotating or just rebalancing
there's all
or adjusting
sorts
their
of
risk
reasons
profile.
That someone will sell or buy or.
You can't be black and white.
Yeah.
If he's smart and he does this and I don't do this, does that make me stupid? No, I just have a different blueprint.
Yep.
Right?
Yep.
I mean, if there's I always tell my kids this, and I think the reason I scream at my kids at this is I hope, because it's been a folly of mine at times, and you fight it every day. Always be bigger than your money, and that basically means don't let the FOMO get you. When guys like I've seen guys start a business, next thing you know they struggle and it's a Ponzi scheme, and but they didn't remain bigger than the money. So if you're freaked out about not being opportunistic with Michael, and maybe he's right, and we get The Big Short 2.0, and now we get to go see another movie together, which would be great. Okay, we're making that date right now.
Yeah, we'll go on a mandate,
and there'll be more people in the bathtub teaching us about short positions.
It'd be a great movie, but even better, we'll have bargains to buy, and that's the opportunity.
And here's the thing: it doesn't change because I'm still going to say, look, I want to be protected. I want to know what a put is. But I'm going to buy mine defensively as opposed to opportunistically, or I'm going to take a short position on the S&P futures or QQQ futures to neutralize rather than be optimistic. Let it drop.
Yep.
Buy if it goes.
If you've got the education level and you know what to do, we don't necessarily know when to do it all the time. But the market will present enough information to us at a certain point. It's okay if we leave some money on the table. But if we know how to lock down that risk, we can buy the position. We can collar the position, which is one of my favorite. You don't have to be that risky or risk, like speculate on the insurance. If you know how to sell the option to pay for the insurance, and you can lock down your risk, you can still collect your dividend regardless of what the market's doing.
Yeah. And even if you want to, here's what I believe. Humankind wants to stay alive. They want to have food, clothing, and shelter. Humankind wants innovation. Humankind wants opportunity. And I think Buffett really believes in that, particularly in the American scene. I mean, he believes in American business. So even if you have that big short, I think that long term, you're always going to have the new highs. Mm-hmm. You're always going to have the new highs. You're going to have some Enrons along the way and some WorldComs along the way and some, we could list the carnage.
And whatever.
Yep. You're going to have that stuff. You're going to have your pandemics. You're going to have your meltdowns. You're going to have your depressions. But the resiliency
will always be there,
is always be there. And I don't think I'm old enough to think that I got to start timing the last 30 years of my life here.
Well, yeah. I mean, if you said there was going to be a world war, that would scare you out of stocks. And then you said there was going to be a World War Part 2. That would scare you out of stocks. And if you said there was going to be natural disasters and terrorists, there's a saying that the market climbs the wall of worry.
Oh,
right?
I saw license plates around once that said Jesus is coming, buy puts.
Yeah.
Is that bad news?
Well, nobody's been correct on the prediction yet, but there's been plenty of put spots.
Man, yeah.
I would think that you'd want to. I mean, if he's coming, and then buy calls, because that.
See, and I would just start repenting, really hard.
Yeah, Look busy.
Puts would be the last thing on my mind. Right. It'd be all the skeletons in my closet that I could clean out. Don't you have it? You got to go in the little closet and say, hey, how much time you got? How much time you got? Because I got a lot of people say, Andy, you can tell when someone's dumber than me because they say, Andy, you should run for president. I'm like, you kidding me? I got more skeletons in my closet than you can. I would never survive that gauntlet, right?
See, anyone that says that they should never be the president is probably the best candidate we've ever had.
Probably.
Let's shift into that, man. Oh, man. So I think the lesson that I hope we're learning, or at least considering, is learn principles that you believe are true in all cases. And I think one principle might be that maybe it's not a principle, but it's an argument that the defining characteristic, maybe you can make this argument, that the defining characteristic of markets might be unpredictability in terms of swings, right? Short-term predictions are really, really hard. And yet we endlessly want to predict it because if you had the DeLorean with the flux capacitor and you could go back to the future, to however that works, you could get that sports almanac and go to Vegas and everything and you'd bet on Buster Douglas and that would set you up for life.
Exactly right.
You bet on Buster Douglas and you'd bet on Holly Holm.
I wonder how much Mike Tyson will bite Evander Holyfield's ear. How much would that have paid off?
Now we're just trying to be like Rogan talking MMA, right? We're not in his league, are we? Talking Holly Holm.
Yeah. I don't know.
Ronda Rousey.
There you go.
I'm Owen. Hey, Rogan. I'm 0-1 in my MMA career, man. I'm 0-1. My wife doesn't like that story. It was her birthday.
Oh yeah.
And I said, hey, sweetie. Her sister lived in Denver at the time. I said, sweetie, why don't you go visit it was either her sister's birthday or I can't remember, but someone had a birthday. And I said, hey, why don't you? This is the only time I've ever done anything behind her back. And she comes back, and I got a black What happened? I fell. Yeah. She knew. So that was the beginning and end of my MMA career. So I'm no Joe Rogan, that's for sure.
Well, I heard a great story about Andy, kind of along those same lines about what a good friend you are, because our friend Alfred was in an MMA match, but Andy had to speak in Vegas. And Andy's a big guy, so getting into an airplane. So he spoke in Vegas, flew back, watched Alfred in his MMA, jumped right back on a plane and flew back to Vegas. So it could be back that. I mean, that's a good friend, right?
Well, yeah. I mean, I drove across town to the same fight, but
we bought all the tables. Remember that?
Yes.
We bought all. So we were going to bring a contingency
Yeah.
to make sure our boy Alfred would get the knockout.
and he won his match.
Oh, what a feeling!
It was awesome.
Yeah, it was fun to see him. He ran. He used to do a lot of stuff for our company in terms of our social media. So knockout punch. Hey, thanks for the insight, Corey. Particularly, anything you want to see more on the oil?
Well,
you kind of started down that road before we closed.
Yeah, I mean, I think it's interesting just where they had the opportunity to lock in great prices for taxpayers and so on, and didn't take that opportunity. And so really, the Biden administration is on the opposite side of Warren Buffett, speaking to who's smarter and who knows what, because what's Warren Buffett been buying more than any other stock in the past couple of years? Occidental Petroleum.
Yeah.
They're not buying Oxy if they don't think oil prices are going significantly higher. So you've got the U.S. government selling oil. You've got Warren Buffett buying aggressively into the oil space. Who's gonna win that battle? It'll be interesting to see. But I would say that certainly they missed an opportunity. Will they get a second chance? Will oil prices collapse back down a bit, and they'll be able to fill back up the SPR at great prices and make the taxpayer a lot of money? Or what if oil prices go back up? What if they hit 100? What if they go to 120 and the SPR's at all-time lows? Well, what do they do at that point? Do they go ahead and capitulate and buy the oil? Do they say, we're out of options to drive that? Because that's what they use that for, is when there's disruptions and when they need to come up with oil, they've got some there to fill in, right? If there was a terrorist activity where they knocked out a huge supply of oil, the U.S. government can pick up the slack in the short term and say, hey, we've got reserves here. We've got enough oil to get us through the next couple of months. When they take that down to record-breaking low levels over the past decades, that's an interesting dynamic that they're in, and they haven't filled it back up yet.
I look at the discussion on climate change and global warming, and I observe it. I don't buy into it either side because I have no idea. You know what? I don't get into all that mask, no mask, vaccine. I don't know any of that crap, but I watch it. And what I think is interesting is I think it's 84% of energy in the world is coming from fossil fuels. That's down 2% from 86, I think, something like over the last 20 years.
You're not going to stop the growing economies of India, China, Africa. I mean, their consumption is doing nothing but going up.
They want our lifestyle, and that takes energy. So I don't really know what the science is, but I don't really care as much as I care about what people's perceptions are and what the culture believes, because it's the same as the gold piece. You know, there was a guy that had a mine, and he minted some gold coins. So I bought one from him. I think it was like when gold was like $700 an ounce or something. I bought one, and I was showing it to Robert, and he goes, "It's not a Cougar end. It's not a Philharmonic. It's not a maple leaf, and it's not a golden eagle." It's, you know, but it was still gold. It was still fungible. It was real. You know, weighted, assayed. It's still gold. Well, I kind of look at energy the same way. Is right now I'm heavy. Like one of my largest positions is in Exxon, and it's been. I bought that thing. It might have been one of the best trades I've ever made, because we bought it coming out of COVID. You know, doubled, and the dividends gone up, and the options have been rich even when the VIX has been low.
Yep.
And it's just been awesome everywhere around. But I'll tell you, I look at nuclear, and I look at AI, and I look at the opportunities of the future. I get pretty excited, because if, you know, depending on how you could position yourself in nuclear, everything I'm reading on this stuff and the perceptions of people is that nuclear is the only choice you got. I mean,
I think it is. If you're having a serious conversation, it's the best solution.
You can run a nuclear submarine for 30 years and never come up for air.
There's so much fear surrounding it, you know, with your Chernobyls, your 3 Mile Islands, and your...
Yeah, that's the same as, like, marijuana and psychedelics and all, everyone was scared of all that stuff. I haven't tried the psychedelics. I'm not making a confession.
We'll do that when we go to the movie.
If we ever do psychedelics, we'll do it on the podcast. Can we make that?
Yeah. Can we all agree? If Michael Burry gets the short right and he makes a fortune, we all come back and do a podcast
on mushrooms.
The psychedelics.
We're going to do a podcast on psychedelics. No, not on the topic.
We're going to be eating the brownies.
I don't know if you guys will be able to tell the difference.
Yeah, they wouldn't know that. No one would know.
Everyone's like, wait, aren't you on them right now? Is this normal?
Yeah, exactly. Hey, great discussion. If you don't know what a short is, if you don't know what a put is, if you don't know what a call is, if you don't know what a CDO is or a credit default swap, these are words that I think would be advisable to learn at a minimum. And if you're relying on the opinions of a Newton or an Einstein or a Buffett, those guys can be wrong. And I laud, to me, when Warren Buffett passes and Munger passes, and that's going to happen someday, I'll be as devastated as any person when I hear that news. That doesn't mean they're perfect. They're not demigods. It's not like we're talking about Hercules here. We're talking about human beings that can make mistakes.
Yep.
So get your plan, get yourself educated, and say, hey, this is what I can control, and try not to be seduced by the siren song. And hey, if this works out for Michael, then we'll salute him and we'll say, man, the dude is just amazing. And I didn't make all that money with him. But I do believe the way to wealth is to buy assets.
Indeed.
And while there are opportunistic times in hindsight, and there are potentials there, I don't know that a 93% of most position sizes are 1 or 2%. And even if you flip that one to 8%, that'd be pretty aggressive.
Yeah.
That's pushing all your chips on the table, and there's no bluffing.
Yeah.
So.
Boy, I'll tell you, it's going to be interesting. I wish I knew the term.
Yeah.
It'd be really interesting.
The details on it. It's got to be a longer term option, I would imagine.
Yeah, it has to be. Well, that's a lot of time to buy. And the other reason it makes sense to be long term is decay is really
slower.
Decay is slower. Once that decay speeds up, we'll see if he changes his mind.
Yeah.
So, and it could be a technical move too. The market's been resilient considering. If you'd have told me the market is where it is, considering the Fed's moves, I wouldn't have believed it.
Yeah.
So gold's resilient, market's been resilient, real estate fairly resilient. So
we're just 3% off those highs. So
yeah, we'll see. All right. You've been listening. I think my guest, Corey and Noah, you've been listening to the Cashflow Academy podcast. We've done our best to make this simple. We'll see you next time.